Hello class. In this video, we're going to talk about something called earnings quality. And then we're going to use a very famous company, Tesla, to illustrate what's the difference between GAAP earnings and non-GAAP earnings and why SEC accused Tesla of tailoring their earnings. In the previous income statement, we look at Zoom and we also look at Coca-Cola. And now let's look at Google. This is in 2015, Google's income statement. And every item is similar to what we have just learned, except from here. Now we have a net income from continuing operations. And then this part, we have another one called net income from discontinued operations. In 2015, the number is 0. But in 2014, there is a positive 516. And in 2013, right, there is a negative 427 for this net income or loss from discontinued operation. What is it? This is the note right underneath the income statement of Google. In the second paragraph, in 2013, Google sold Motorola home business to Ares Group. The financial results of Motorola's home are presented as net income / loss from discontinued operations. And then the last but one paragraph, in 2014, we sold the Motorola mobile business to Lenovo. The financial results of this Motorola mobile, the sector that Google sold, are presented as net income loss from discontinued operation. So the line item that we saw here, all right, of negative 427 is from selling Motorola home, while 516, the positive number in 2014, is the Motorola mobile. So then the natural question that we have is, why do we have to make a distinction between this income from continuing operations and separately report the items? Well, the key reason is that it will be easier for the investors to assess earnings quality. So what is the quality of earnings? Well, it generally means the ability of reported earnings to predict the company's future earnings. Keyword, predict. Now, suppose I am an investor. I am presented with a 2020 company's income statement. And I want to make a judgment. I want to know if I invest now in 2020, will the company also have a good year in 2021 so that I can make money in the next year? Then I will judge the 2020 income statement and then think about which line item can predict the future earnings. Then we will learn, which one is temporary, which one is more likely to persist in the future, right? So then it leads to the second point. Some items on the income statement are transitory, which means it's just one-time thing if you're likely to change, while others are permanent, which means it will persist in the future. So as a future investor, I want to know which items are going to be permanent so I can make my judgment, make my prediction based on these permanent items. This distinction is very important for me, right? Because I'm trying to predict the company's future earnings and cash flows. The temporary earnings will affect these temporary earnings effects result from transactions that are not likely to occur again in the foreseeable future. And it is likely to have a different impact on earnings in the future. While the permanent earnings, the second one, the one that I want to focus, relate to operations that are expected to generate similar profits in the future. And it should be included in the income from continuing operations. Again, when we look at Google sold Motorola, those that the transactions that we sold, they are not gonna happen again in the future, or they happen, right? We sold Motorola Home, and then the next year we again sold Motorola Mobile, but it affects our earnings in a different amount. The first one is a negative, the second one is a positive, right? It's a huge difference. So we will put these transitory items into discontinued operations. And if I, as an investor, want to make prediction, I will only focus on all these. So all these until net income from continuing operations. I will ignore the next one, the discontinued, because it doesn't help me to predict future earnings. Now, a quick concept check. You can pause here and figure it out yourself. The answer is both A and C. Temporary earnings is earnings from transactions that are not likely to occur again in the foreseeable future. This is A. And also, these are earnings from transactions that are likely to have a different impact on income in the future, which is C. I'm going to skip the concept of income smoothing and classification shifting. It is very straightforward. And, we always want our income to look like the blue one, steadily increase instead of very volatile increase first, but then we have a drop and then we have an increase. Income smoothing can help you do that. Now, the other one, classification shifting, is to shift the amount, the expense from one classification to another one. We want to talk about the predictability of the net income, right, of the earnings. Because as an investor, I want to invest in the market and want to base on the past earnings to predict the future. But actually, there is a declining relevance of this net income. So this graph is like I just roughly plotted it myself. It is from 1986 to 2015. This is the abnormal gain here. So if I'm going to predict, if I'm going to buy with a positive earnings and then sell with negative earnings, the gain is shrinking. So that means there is less and less correlation between the income statement's net income and the stock market's stock return of the same company. So maybe you have a good year in your net income, but your stock doesn't perform well. And in fact, the relevance is steadily reducing, declining. And then I have to introduce another concept, which is called non-GAAP earnings. Now, companies are required to report earnings based on the generally accepted accounting principles. We talk about it in week 1. And this includes all the revenues, expenses, gains, and losses, right? Now, most of the companies also voluntarily, meaning they don't have to do it, but they like to do it and they do it anyway. They voluntarily provide a non-GAAP earnings, which exclude certain revenues and expenses. So they do it in their way. Each company has a different way of calculating their own non-GAAP earnings. Examples are, restructuring costs, acquisition costs, write-downs of impaired assets, and stock-based compensation. Non-GAAP earnings are actually quite controversial because the expenses to exclude are really at the discretion of the management. So, you can say that this is not really something that you care, but it happens. So, if you have a really risky and aggressive manager or CEO, you would do it like at your random way. And if I believe your non-GAAP, I am taking the risk, right? So the Sarbanes-Oxley Act in 2002, the one that I talked about in week 1, this act realized the problem and it addressed this non-GAAP earnings in their section 401. One of the act's important provisions require that if non-GAAP earnings are included in your report, and you filed it with the SEC or in any public disclosure or press release, the company also must provide a reconciliation with earnings determined according to GAAP. What does it mean? It means that you have to show me how do you come up with your non-GAAP number, you know, from a GAAP to non-GAAP, what do you exclude, what do you include? You know, tell me the way so that I can see through your calculation, and as investors, I may easily spot, you know, where you make the aggressive move. Now, as you see, this non-GAAP earnings, right? It's really, as long as, you know, there is to some extension, the manager have the right to decide what to include and exclude. Manager always want to include, you know, all the calculation to a, you know, a more beneficial way to make the firm's numbers look nicer. Now, this is the S&P earnings per share, EPS, annual. S&P 500 is an index. It includes 500 big companies. The green one is pro forma or non-GAAP, right? We call non-GAAP the second name pro forma. Green is pro forma, and the purple is according to GAAP, the EPS. What is the EPS according to GAAP? So we have 17 years. 15 out of the 17 years, you will see the pro forma, the non-GAAP EPS greater than the GAAP EPS. The green bar, right, is always above, except this year, right after the, you know, financial crisis, and we start with an equal one. Other than that, every non-GAAP EPS is greater than the GAAP. So you see there must be something. It's easier to, you know, have something fraudulent going on. Reporting a non-GAAP earnings is nowadays really a common practice, especially among young and growth companies. It is not really necessarily a red flag of fraudulent accountings, because like most companies do it, and most companies report higher non-GAAP than the GAAP earnings, right? But, you know, if you want to stretch the line a bit too far, the SEC will still have an eye on you. In the background reading, I posted a Wall Street Journal article in 2016 where the SEC accused Tesla of tailoring their non-GAAP earnings. Actually, Tesla has done it, you know, way before 2016. That's exactly because they, you know, aggressively do it for consecutive years. The SEC has to step out. You can take a look at the background reading, the Wall Street articles. Here, I posted the Tesla 2013 Q2 earnings. To the right-hand side, you will see the GAAP, right? This is according to our generally accepted accounting principle, our income statement, the one that we talked about before. Now, the very end, they have a net loss, so it is a negative number, right? So and it is almost 31 million, but they also provided this non-GAAP earnings, and in it they focus, you know, this is what they say: while profits were still modest in absolute terms, but I mean, if it is not absolute term, you have a negative. In absolute term, you have a small number. And it is not our primary mission. Well, really. The non-GAAP net income in Q2 was $26 million. So you have a negative 31. And after this plus and minus, you get it to a positive, and not necessarily positive. It's positive $26 million. This is really, really aggressive. You have a negative and now it's a positive, and it's a good, promising year. So how do they play this game? The key issues here is that they recognize the full amount of leasing program revenue. So basically, if I lease a car, if I lease a Tesla, right? I'm leasing it for 3 years. So in each year, you're gonna, recognize revenue for that year only. But Tesla, in their non-GAAP, because they have to, this is what they voluntarily do. They don't have to follow the GAAP. They would recognize all the 3 years revenue upfront. So, that basically triple. And the second thing is that they remove one of the expense, so that, net income with fewer expenses would increase the net income. What do they remove? They remove the employee stock-based compensation. Well, that's a common thing to remove. In the previous slides, we talk about this. Now, let me switch to the Tesla non-GAAP recording. I also post this article in our background reading. This is Tesla's non-GAAP earnings. And in the last page, right, remember our Sarbanes-Oxley Act requires a reconciliation between GAAP and non-GAAP. This is Tesla's reconciliation. Now we can quickly browse it. What is the R&D expense under GAAP? What is the R&D expense under non-GAAP? Under GAAP is higher, but under non-GAAP, they exclude those compensation for your R&D, for your researchers. So the actual expense is smaller, change from 52 to 43. Now look at net income. This is under GAAP, what our SEC and FASB required. It is a negative 30 million, almost 31 million, right? They exclude all this stock-based compensation, exclude this, and non-cash interest. And then they come to this net income, non-GAAP, including the lease accounting, which is already a positive term. So by just excluding, the expenses, sort of you subtract less from the net income, you have a positive number. And then again, we talk about how they recognize all the lease accounting upfront. These sums up to $90 million. So plus the $90 million, right? These two numbers, $6,000 million and $90 million equals 26. This is how they come up, with the positive $26 million non-GAAP. So as you see, companies can do really aggressive recognition for their non-GAAP. And that's it because, Elon Musk thinks that this is more related to the future of their companies. And you should think of me as a positive $26 million instead of a negative $31 million. But, it is not necessarily fraudulent, but you have to pay extra attention to this GAAP versus non-GAAP. Both articles are posted in the background reading. It's very interesting. Take a look. And I'll see you in the next video.